I play the piano, but it's
Ew.
been a while.
You play.
Ew.
No, I'm saying you have to learn that. Ugh.
I can read music, but I don't think I could sit down and play scales. I have to have my book.
Piano scales are easy.
No, piano scales are easy. It's just like learning to play like full pieces on piano is. There's too many keys for me.
It's a few.
Once you know the first beat, it's good.
I'm a brass player. I dealt with 3 buttons my whole life. All right.
Yeah, but getting it to make different noises with just 3 buttons is fascinating. Getting it to make different notes with just
Well, so
the
there's
3
like
buttons.
certain combinations for the same
Kind of
notes.
that
You just
sound
have to,
off your
like-
bat.
Hey, I used to play piano.
Oh, did you? Impressive. My son plays.
My mom made me.
My son wanted to, and he actually did really well. But he likes to, he'll find a piece he likes, a song he likes, and he'll listen to it on whatever, YouTube or wherever he's finding it. He'll learn it that way. He'll have the music too, but he'll learn it that way. But once he starts playing it, he can play it really well. I mean, it's like a couple, 2-3 years maybe he's been taking lessons.
My favorite thing was I was handed a piccolo trumpet once, and it had 4 buttons on it. I'm like, how does the 4th button work? Like, I don't know how this works. So I'm like,
I want to play the guitar, but
It makes you feel better.
you having to shift and like remember all of that is like,
Play guitar here.
yep, pianist for me. Love it. So can you still play, Sean?
I played for 7 years. Yeah, I quit because of baseball.
You can pick it back up if you ever decide to.
Uh,
Because I quit, like when I went off to college, I didn't play because I didn't have a piano around, and I had played since kindergarten. And once I moved into a house big enough to put my piano in, which I mean was years later, and even then it was years before I started taking lessons again, and I took lessons for a few years, and it took a little bit, but I picked it back up. But again, I'm too busy to do it now, which I need to because I like it. And I mean, if you can do it, you shouldn't let it rust, you know. But anyway, okay. So anyway, we started on Monday with the adjusting process. And the reason we have to do adjustments is because we use the accrual basis of accounting, which means transactions happen even if cash hasn't changed hands yet. And we record those transactions once they've happened, regardless of the cash flow, because they affect the revenue or expenses. And if we're going to get an accurate picture of how the business is doing, we have to capture everything for every period in that period. So we've really kind of done a whole lot of this already. We just are kind of expanding on it. You'll have revenues and expenses that might not be recorded at the end of a period, an accounting period, which could be a month. It's usually going to be a month or a year. But, you know, we've had situations where somebody's provided services, but they haven't billed customers yet. We've had those. Accounts receivable, fees earned. Who's had a job before? Who's working now or whatever. So you know how payroll periods work. Like it may be Monday through Friday and you get paid the next Friday. Well, if you've got a payroll period that, and most of the time you're going to have the month end in the middle of that payroll period. Now you as an employee don't know the difference because you're still going to get your same paycheck, or your paycheck's going to come on the same day. And it's going to be for that same time period. They're not going to cut off at the end of the month and give you a piece of a paycheck here and a piece there. But the expenses for the time you've worked, for the days that were included in that month that's ending, we're going to show as expense on that month that's ending. So if you work 3 days out of the payroll period, then that time, that money they owe you for that time you work, they're going to want to pick up in that month that's ending because it goes there. You've already worked that time. We talked about supplies, how, you know, that the company may go buy a whole bunch of supplies that are going to last for several months, but they're not going to make an entry every time somebody gets something out of there. It's just not practical. So we'll do that at the end of the month. We've had those entries where Net Solutions was one of them, where he determined how much was on hand, and we made an adjustment to expense to account for what was used. So we've already done that. And then we talked about with Net Solutions, where they rented that land they bought to a local retailer to use for parking lot space. They paid up front 3 months worth, $360. And then that was at the beginning of the month. And I told y'all, okay, we'll deal with this in the next chapter. So at the end of every month, time has passed. So now they have a month's worth of rent. But the time has to pass. You have to allow somebody to occupy your space for you to have rent revenue. But you're not going to record it every day, which you could, but it's just too much. It's not cost effective. It doesn't make sense to make an entry every day. So those kinds of things you do at the end of the month. Same thing with prepaid insurance. We had those problems where a year's worth of insurance was paid at one time and it was paid at the first of the month. So you're not going to have any benefit until some time has passed. So every day you have that insurance policy, then you've gotten the benefit of that coverage and that part of the coverage is expired, but you're going to make that entry once a month just to be practical about it. Okay, the whole object of showing revenues and the periods that they're earned in, that's revenue recognition principle. Expenses in the period that they occurred in, that's expense recognition principle. And I was telling the classes on Monday that when you see the word incurred, like it says expenses incurred in generating revenue, it's too sensitive when I don't want it to be. Now I can't get it to move. I love technology. The word incurred means occurred. It happened. It took place. When you've been incurred an expense, you've gotten the benefit of something, or you've used something up, or it's happened. I actually looked incurred up in the dictionary trying to make it a more simple explanation of the word, and it said occurred. So just think about that as occurred when you see incurred. It's a fancy accounting word somebody came up with. All right, so the matching principle you're probably going to see again. The matching principle means I'm recognizing or I'm recording all my revenue that took place in this period. I'm recording all my expenses in this period. Because let's say you've got an electricity bill for your office building. Well, you need to recognize that, you need to record that electricity bill in the month that it goes in, the month that you use that electricity, because in the process of occupying that space and using that electricity, you were doing that in the process of doing business, which means you were using that electricity to produce revenue as your end goal. So match those together. They need to be together so you can actually see how the business is doing. All right, so the adjusting process, we're going to look at our accounts and see what needs to be recorded, what needs to be done. This is always done at the end of the period. So we've already recorded all of our transactions, all of our day-to-day journal entries. This is something we do after that, and it's going to update the accounts. So anything that is not recorded or anything that we need to show that some rent revenue has been recognized, or, and so on, we'll do all of that at the end of the month, but we'll do it before we do the financial statements. Now, in our first couple of chapters, we just recorded transactions, did the financial statements, but we weren't to this point yet. So now that we know we got to do adjusting entries, record transactions, post them to the ledger, go back and do your adjustments, post them to the ledger, then you'll move on to doing financial statements. Y'all following me so far? Okay, no. Okay. This is something to note because you'll see it again. All adjusting entries affect at least one income statement account and one balance sheet account. So in every entry, you'll see a revenue or expense account and an asset or a liability account. So you will see that again on a multiple choice question. All right, and on these adjustments, there's two different types of accounts, or two different kinds of adjustments. You'll have accruals and deferrals. For these accruals, think about that as something that's already happened. That's when revenue's been earned, but we haven't billed the customer yet. Or we have incurred an expense, but we haven't paid it yet. So think about these. I circle this. Ask yourself the question when you're trying to figure it out, which one it is. Has any cash been received or paid out yet? If it's no, then you have an accrual. So the adjusting entry is made to show earned revenue or an expense that's been incurred even though no money has changed hands yet. So again, this is nothing really new to you. We're just kind of expanding on it. We're just kind of naming it and giving it extra terminology and stuff. We're going to go through this exercise in a minute. This is out of your book. So I drew a line there because this is the initial recording. Well, for an accrual, there has been no entry made yet. You're going to have to make an entry to show that expense or show that revenue. And here is the entry that you will make, just generic. Just to kind of help you out, it's a generic entry. You'll change it for, you'll be specific about which expense it is or so on. Or fees earned or rent revenue or whatever. All right, deferrals, that means something in the future. So that's like your prepaid expenses or your unearned revenue. So again, ask yourself, has cash been received or paid out? If it's yes, you have a deferral. So at some point during the month, some cash has either been paid out or some cash has been received, but nothing has happened yet. It hasn't been earned. It hasn't been utilized if it's an expense. So the adjusting entry will be made once revenue is earned or the expense has happened. So these are things like, and I drew this line because this is initial. So somewhere earlier in the month, maybe cash has been received for revenue, like somebody paid ahead of time. And we put the money in cash and unearned revenue. Well, now we're at the end of the month, time has passed, so some revenue's been earned. This is your adjusting entry. So same thing for an expense. Somewhere earlier, you've made an entry to put something in a prepaid expense account, like your insurance. So this is the first day of the month. Then at the end of the month, some of that insurance has expired, so we're going to move it. So with deferrals, you're adjusting something that's already been recorded. For accruals, you're making an entry that has not ever been made yet. Okay. Hello, where are you? I think it's me. I think I have some kind of special rotten touch or something that this thing does not like. There we go. Do y'all want to go through this exercise of naming these things just to help you out? At least I figured out why it wouldn't erase right. The automatic sync thing was on and it was constantly syncing and locking me out. I'm going to say that and it's going to quit erasing. All right, so we're going to look at each one of these scenarios and we're going to determine if it's an accrued revenue, accrued expense, or an unearned revenue or prepaid expense. Go away. All right, so in these, you've got a situation where no money has been received or paid yet. And you will use accounts receivable or accounts payable or something payable. I'll just put blank payable. Could be accounts payable or wages payable, something like that, okay? Something payable. For unearned revenue and prepaid expense, money has been received or paid out. And in this one, you're going to use like unearned revenue and prepaid expense. You'll use unearned fees or unearned rent or prepaid insurance or prepaid rent. So that was a little more straightforward. So again, remember to ask yourself, has any money moved yet? So for this first one, we've got a bill that was received for commercials that have already been run on TV. So is it mentioning that any cash has changed hands yet? No, and it's talking about a bill. So if you've got a bill, then it's likely you haven't paid it yet, right? And they've already been on TV, so an expense has been incurred. So no money's been received or paid. So what do you think this would be?
Accrued expense.
It's an accrued expense.
Is it okay if we abbreviate them?
Oh, absolutely. Yeah, that's your worksheet. All right, wages owed but not paid yet. So it's not paid, that means no money's gone out.
Accrued expense.
It's another accrued expense. That's where the payroll period or the month ends right in the middle of the payroll period, and it's not time to cut paychecks yet, but you owe a few days of salary or wages. All right, supplies on hand.
Prepaid expense.
Yeah, it's prepaid expense. I told y'all that a while back. I mean, assume that, you know, usually when we bought supplies, it was either with cash or payables. So we got these things on hand and we haven't used them yet. So at some point, money has moved. We've paid for them. But we haven't used them yet. So it's a prepaid expense. Does that make sense? All right, what about fees received but not earned?
Unearned revenue.
Yeah, because you've got fees received. So this is telling you money's been received. Even though it says fees received, if you've received fees, what have you got? You got money. Well, it's a little deceiving because it says fees received, but they're prepaying their fees. The fact that it says not earned yet will tell you that that hasn't happened yet. The actual earning of the revenue has not happened yet. They've got fees that were paid to them ahead of time. They're not earned fees. That can be that's a little tricky. So we're gonna put this as unearned revenue because the question specifically tells you not earned. Premium paid on insurance policy. So we know some cash went out, and this is covering one whole year. It's a prepaid expense. This part, to me, is a little more difficult just to identify the things. The entries that you make for all this stuff, we've been making for the most part. So it's not like it's something different. It's kind of explaining them in more depth. Fees earned but not received yet. Accrued revenue. All right, so let's look at these journal entries since y'all kind of missed this. And we may fly through them, I don't know. Y'all may not have any trouble with them since who didn't do their homework? You didn't do it?
I did.
You did?
Mm.
Did you pass it?
I did.
Good for you. I wonder sometimes how many of y'all are together like doing it as a group.
Not me.
You? Don't y'all study, does baseball have study hall? I know that y'all used to do that.
We used to have
Y'all don't get together and do it together?
kind of goof off.
Okay.
No, I'm just kidding.
I guess it depends on who's there. All right, on the last day of the year, Waterhouse Irrigation has earned $23,000 in fees, but has not billed the customers yet. So if they hadn't billed them, they hadn't got paid. So we're gonna debit accounts receivable. And we're gonna credit fees earned. We've done this one before. Y'all have seen it before, right? We've done entries just like this. Okay. This was the one that was kind of interesting. And y'all have one like this on your homework, I think. So we probably know how to do it. of the salary one?
Yeah, like where you had to like put down how much you had. Yeah, I couldn't figure it out. I just left it on this one.
All right, so we've got this pharmacy. Here, I'll just leave it. Well, it's not gonna necessarily make sense. You've got this pharmacy and they pay salaries every Friday. They make a paycheck. They cut payroll, sorry. Cut paychecks. If I say something y'all don't understand, stop me because it's such a habit. Saying things a certain way because I've just been doing it so long. You may have no clue what the heck I'm talking about because you haven't done this. So just stop me and go, what is that? Okay, so they have weekly salaries. And this is everybody. Everybody they pay a total of $6,800 on Friday. They have a 6-day work week, and it covers Monday through Saturday. All right, so assuming that the month ends on Wednesday, we need to journalize the entry to record accrued expenses, which would be those salaries. All right, so the first thing you have to do is take the weekly amount of $6,800, and you're going to divide by that 6 days in their work week. Work week. It's 1133, right? So you take total, divide it by the number of days they say are in your work week, and that gives you the amount per day. What can get tricky is how many days. This one kind of tripped me up. I think it was Monday. You've got Monday, Tuesday, Wednesday, Thursday, Friday, Saturday. Okay, well, this is payday. So you've got Saturday, Monday, Tuesday, and Wednesday, and this is the last day of the month. So we've got 4 days between payday and the month ended. I guess we could just put a line on one side. So we've got to pick up 4 days worth. So 1133 times 4 days is how much? 47 something.
4532.
4532? Remembering the wrong number. So that's this is how much you owe the employees for the days since last payday. So you're gonna record salaries expense as a debit. Salaries payable as a credit. And y'all don't sweat it if you like totally tank on a homework grade or something. At the end of the semester, I usually drop at least 2 homework grades and 1 quiz grade. So I can go ahead and put those parameters in there, but I see over the past several semesters that a lot of students have a tendency, oh, I'll use that one as a drop grade. And then it gets on into the semester and they're like totally confused on something and they've already eaten up their drop grades because they were not wanting to do homework. So I just I'm throwing that out there so you don't like get upset if you have a couple of bad grades on homework or quizzes, because it'll get dropped. And I let Canvas do it because it takes into account how many points does this particular assignment affect the whole grade. It drops the ones that are going to help your grade the most. So I don't personally go in there and figure all that out. All right, does this make sense? Okay, so when it comes time to cut the payroll checks, they'll show salary expense for those other 2 days. They'll get rid of the salaries payable, and then cash of $6,800 will go out. Does that make sense? Okay. All right, so unearned revenue. We've done this, not this one, that you can't see. Okay, this one's fairly easy. On May 1st, this rental management company received $25 grand for the rental of a property, May through September. So you've got May, June, July, October, August, September. You've got 5 months. So we're going to divide that whole amount by 5 to get our amount per month. My mouth is moving faster than the brain. So at the end of May, we have earned 1 month's worth of rent. So we'll take 1 month out of unearned rent and recognize 1 month of rent. Okay, I'll just hang on.
No, I was wondering if you wrote -5 up there or divided by 5.
That's divided by.
I was about to say,
It's divided by. There were tiny dots. So remember, this is done at the end of the month. And when you have deferrals, when this check was received on May 1st, we would have debited cash for 25 and credited unearned revenue. So that's already there. So what we're doing is moving that piece out of unearned rent that's been earned by the end of the month. Because when I would first look at these, I'd go, why are we doing it? You got to think back to, in these types of entries, deferrals, you've already had an entry made to put something in unearned rent. So, y'all good? Okay. All right, this is kind of a similar thing on unearned fees. So you've got unearned fees. The balance before it's adjusted at the end of the year is $78,000. I did this as a T account because it just made more sense to me. So unearned fees, remember, is a liability account. It would have a normal credit balance. So I did this T account to show you we're starting out with 78. We're supposed to end up with 65. So you can just kind of plug it for the difference that it's going to take to get our balance to the right amount. So it's 13. So we'll debit our unearned fees for 13 and credit our fees on. Does that make sense?
Why do you put a date in?
Did they give us a date? They just say end of the year, but you know, if a company has a calendar year, we could put December 31, but what if they're like a fiscal year that ends June 30? We don't have a clue. So you don't really have enough information to put a date in. I mean, if we need to, we can. It really bothers me. Because I would understand that, because that kind of stuff used to really bother me. Not have all the details. That's why I'm a nerdy accountant. All right, prepaid expense. This is supplies and supplies expense. We've done one just like this before. I think we did it when we were looking for missing amounts and accounts. We started the year with a $1,300 balance. They bought $3,685 during the year, so we debited supplies for that amount. And at the end of the year, we've got 2010 on hand. So we would have to figure out what to credit this account to get supplies expense. So we've done this one before. It shouldn't be too different. Y'all raise your hand or say something if y'all don't understand what we're talking about. Don't be lost. You're not going to be the only one that's lost. You'll just be the only one that says something.
what's the sign of the 2975?
It's just a storm. I can't put it out there. I guess because what I'm telling you is that's what goes there. Okay, something to keep in mind too, because I saw a lot of people do this on the test. Every journal entry has got to have a debit and a credit. I saw several cases where, and I could see what happened. It's kind of like there was, you get on the test and you get confused. Is this a trial balance or what am I doing here? I can't remember. There's too much information. And so it was like only one side of the entry was made for every transaction. So just make sure you remember when you are recording transactions or adjustments, which these are adjusting journal entries. They will go in your journal after you've recorded all your transactions for the month, but they're still journal entries. All right, prepaid expense. We've had one of these too. This is the same kind of thing we just did for supplies. When you see unexpired, that means how much do you have left? How much is still good? Think about it like coupons. If you have unexpired coupons, then they're still good. You can still use them. If you have unexpired insurance, then you still have coverage. Do y'all even know anything about insurance? When I was y'all's age, I had no idea. No? Do what?
I have car insurance.
Do you pay for it?
Yeah.
So you really know what it's for. If you have to pay for it, you get educated real fast. Yeah, car insurance. And there's all kinds of pieces to car insurance. Insurance is complicated. You got collision, you got liability.
Thankfully, my mom does insurance stuff, so I had her to explain everything.
Yeah, that's the benefit of hiring people that know how to do things. Just make sure you get somebody you can trust.
Insurance is messy.
Insurance is messy, and if you have a bad driving record, it's even worse. All right, so we plug this to get the balance we want. Does that make sense to y'all? Yeah, right? Okay, so the next thing we're moving into is how to show expense for those big purchase assets. All right, so we've had transactions where land was purchased or equipment was purchased, I think, or we've talked about vehicles, buildings. Those are all fixed assets. That's what they're called, fixed assets. I don't know why. They're also called plant assets. I really need to look that up, and I think I have, and I just forgot what I found out. I think it has something to do with, like, in the old days, manufacturing plants, you know, plant assets they're thinking about. I don't know. But anyway, you'll see them called fixed assets, plant assets, and eventually property, plant, and equipment. But anyway, all that means is assets with long lives. So you've got land, buildings, cars, equipment. You could have tractors, or you could have a copy machine. It's all equipment. Okay, so they're kind of like a long-term prepaid expense because you paid money for this asset and it's going to be useful for a long time, but the more you use it, it's wearing out. So you want to account for that wearing out of that cost, but we're not going to like expense an entire building in 1 month when we purchase it. That just doesn't make sense because our books would look really awful if we expensed a $300,000 building in 1 month. And the building's going to last for a long time. Just look at this one. So think about it. This building's been here since the 50s. I'm sure they've done multiple renovations, lots of Band-Aids. But the building is not in the same condition it was when they not broke ground, but when they finished it and, the students and the faculty moved in. But it's still useful. But over time, with the wear and tear of weather and people walking on the floors and wearing the floors out, or humidity, all those things, leaking, all that stuff, it's wearing and tearing on the building. So what we do is we use an account called depreciation expense because the loss of that usefulness and the wear and tear, that's depreciation. You've heard that used with your car. It's not quite the same thing, but it's the same concept, but it's not an expense for you. I had somebody try to use that on me one time. It's funny. As an individual, we don't really get the benefit of depreciation expense. A business gets a tax write-off for it. And so I've told y'all before, my mind's always on the tax focus of things. So I think of depreciation expense as a tax benefit. But also, you've got to, as a business, show that as an expense because you've got this building you're using in the process of earning revenue. This building right now is being used by us to earn revenue for the college. Y'all pay tuition, that's revenue. So we're using it. It goes with the revenue, the tuition. So we'll record that as expense. We'll call it depreciation expense. But we're not going to credit the asset every time we record it. We're going to use a different account. It's called accumulated depreciation. It's going to have a normal credit balance. It's going to look weird to y'all because it's like they'll be together. But this account is called a contra asset account. You will see that again. So mark it or highlight it or whatever. A contra asset is an account that has a normal balance that's opposite of the one it's being combined with. So that balance in that accumulated depreciation account is going to be deducted from, it'll be combined with that asset account to determine what's called book value. So like on your balance sheet, we didn't want to come off, did it? Let's say you have you'll start with your cash and you'll have accounts receivable. Then you'll have supplies. And then let's say you get to equipment. And right below it, you'll have, I'm abbreviating because these are long. You have an accumulated depreciation account for each class of each account, which is a little crazy. Let's say you had 1,000, you had 5,000. I'm just pulling numbers out. Let's say you had 50,000 in equipment, and maybe over the years you've shown 10,000 in depreciation expense. Well, when you get your total assets, you're going to combine these two. You'll subtract the 10. So your book value of your asset here will show up as 40 net. Just lost. You're going to have to get Botox when you get older because you're going to have that little line like I do. I need to get it now. I just don't want to. I don't want to look like a plastic baby doll. That would happen to me. I'd get too much and I'd look plastic. What I'm trying to show you though is that in the line of the chart of accounts in the balance sheet, it's going to fall. These accumulated depreciation accounts are going to fall right under the asset account. This is the way we show how much depreciation has been taken over time, accumulated depreciation. And when you combine those two together, you can tell how much undepreciated value do I have of this asset. Now, is that the same as market value? No, because you might be able to sell that equipment for more than $40,000. But book value, it's an estimate. When we do these problems, they'll just give us those numbers. You don't have to figure them out. Okay. Do I need to open the homework back up for y'all? Are y'all okay?
I wouldn't complain to them because I would know.
Since y'all kind of got cheated on your video. All right, I'll open it back up and I'm not going to assign anything new because it's going to go into depreciation and stuff and we really hadn't played with it yet.
What about the
Attendance plan? I don't know what to do about that because you can't really do it if you can't watch the, but you really can answer the questions now.
Yeah.
So y'all want to go back? I'll open it back up. Actually, it's open still. You can, you can go ahead and take it. And you can take it based on what we did today.
It only gave us like 3 attempts or something, and I've already done all 3 because I didn't know what I was doing.
All right, I'll fix it.
Okay.
I was gonna say, because for the
You
people that
know,
are
I
like
mean-
today that didn't come in, I mean, they're gonna like do the.
We have to be flexible. What do you do?
Yeah, I tried to put the video. I was at my mom's house, and I was like,
Look,
oh my gosh.
I could open it on my computer and I could watch it just fine.